Hi, I'm Scott Starratt, Starratt Wealth Management. January was a strange month in that it started off a little bit lower after a little bit of a Santa Claus rally in December, and November for that matter, but it ended up strong. And so January ended up to be a reasonable month for the markets, very similar to what we've seen, I guess, over the last few months, which is very positive. I think for the year, however, we're going to be in for another volatile year. There's still a great deal of uncertainty around inflation. And although the Federal Reserve in the United States, and to a lesser extent the Bank of Canada and the European Central Bank, have all indicated that they expect to drop interest rates sometime this year, the timing on that drop and the extent of the drop is one of the things that's the biggest question mark at this point. For example, last night, Jerome Powell, who's the Fed chairman, was on 60 Minutes basically saying he or the committee does not want to drop interest rates too fast, because by dropping interest rates too fast, you may stimulate the economy, and by stimulating the economy, prevent inflation from trending lower. So that's the great deal of uncertainty, is going into the end of the year, a lot of people had expected there to be up to 6.25% cuts in the US this year. And the reality is that's probably going to be a little bit unlikely. And the reason is the economy continues to be very strong and inflation continues to be relatively sticky around the 3.5% range. So whereas a lot of people expected there to be a first cut coming in March, which technically is still possible, there's a lot of people on the Federal Reserve, as well as a lot of the commentators now, are saying, well, maybe March might be a little bit too early. The first cut might come in May. And so the longer the economy continues to stay strong in the United States and to a lesser extent in Canada, the more that the interest rates are going to be pushed out. The other interesting thing that's been happening is earnings season. You know, we are now hitting the third quarter earnings, and how are companies doing? And it's really been a mixed bag. And for the stock market to continue to stay as high as it is right now, really you need companies to continue to earn money and more profits. And that isn't growing as much as what some people thought. Some companies are, and those companies are being rewarded, but others aren't. So we continue to have the view that we're in this world that, you know, the economy continues to tick along. There doesn't appear to be a huge recession coming. Doesn't mean that there won't be weakness, but a huge recession. And the question on interest rates is still up in the air. Right now, we're positioned, as you all know, to have more money in stocks than we've had for quite some time. At some point, we may decide to take some money off the table there, but not there yet. And for the most part, we're going to wait and see. We have to wait and see what the economy turns out to be in the US, what happens here with interest rates in Canada, which appears to be on the same downward trend. Once they start cutting interest rates in Canada, you would expect that to have 2 or 3 or 4 cuts this year. And so right now, like I said, it's a wait and see mode. We're looking at continuing to keep the portfolios in a very conservative type of status, and not looking for taking on a whole bunch of additional risk at this point, because the reality is we just don't know what the uncertainty is going to bring for the rest of this year. We're getting into RSP time and tax-free savings account time. So obviously we've made a lot of your contributions to the tax-free savings accounts already. For those who are contributing to RSPs, if we haven't reached out already, we will be very soon. And finally, tax time will hit, which I'll give a little bit more of an update on next month. If you do have anyone who, family members, colleagues, friends, neighbors, that you do feel needs some financial planning, some really good advice, really low risk portfolios that still do comparable returns to the markets, if not better, then please do reach out and let us know. We're more than happy to sit down with them, either virtually or in person, to discuss what their needs might be.